Thank you. Welcome back. I'm Sage and you are watching Kalkine TV live from Sydney, and we're about to bring you the Economic Corner show, where we update you on all the biggest global economic announcements. And apart from the important news from around the globe, today in the show I will also share a special report on China's trade restrictions likely to fall flat as Australia eyes the Asia-Pacific markets. So do stay tuned till the end. And first up on today's Economic Corner are the media reports that 5 Chinese government departments, including the NDRC, the MIIT, the SAMR and the CSRC, summoned major companies in iron ore, steel, copper and aluminium sectors, urging them to safeguard price stability in the commodities market. And the state's media reports point out that China is going to sternly punish commodities monopoly and price violations and pledges for zero tolerance of commodities futures violations. Asia's iron ore futures tumbled on Monday, leading another bout of selling in the metals complex after China's state planner warned against commodity price manipulation and vowed to clamp down on speculative trading. The most traded iron ore contract for September delivery on China's Dalian commodity exchange slid as much as 9.5%, almost hitting the day's downside limit of 10% to $157.87 a tonne. Its weakest since April 15th, and the Dalian iron ore has plunged more than 20% since hitting a record high of 1,358 yuan on May 12th, when tougher environmental restrictions on steel production in China drove a rally in steel prices. The most liquid June contract for the steelmaking ingredient on the Singapore exchange tumbled 7.2% to $177.90 a tonne, its lowest since April 30th. And the National Development and Reform Commission, China's top economic planner, along with other government agencies, urged major domestic commodity companies not to drive up prices in a meeting on Sunday. The talks followed a statement from China's cabinet on Wednesday that the government would manage unreasonable price increases for copper, coal, steel and iron ore. And prices of steel products and other steel inputs also fell sharply, with rebar on the Shanghai Futures Exchange down as much as 6.8% in the early trade, while hot-rolled coil slumped 7.1%. Stainless steel shed as well 1.8%, and the Dalian coking coal lost 5.2%, while coke dropped 6.2%. And moving on, the White House said on Friday that it had pared down its infrastructure bill to $1.7 trillion from $2.25 trillion, with cuts to investments in broadband and roads and bridges. But Republicans dismissed the changes as insufficient for a deal. The White House officials held a call with a group of Republican senators on Friday to hash out some of their differences and present the new draft. Republican US senators have put forward their own proposal, which is much smaller than the White House version. A White House memo showed Biden's new proposal would reduce spending on broadband to $65 billion, down from an initially proposed $100 billion. And spending on roads, bridges and major infrastructure projects would drop to $120 billion, down from Biden's initial proposal of $159 billion, but well above Republicans' desired $48 billion. On the other hand, according to Fitch Ratings, Germany's extended stimulus will push its 2021 budget deficit wider. underscoring the near-term fiscal impact of COVID-19 and the slow start to vaccinations. Germany's record of sound public finances should ensure that the deficit narrows after this year, but post-election policy settings and their impact on the pace of deficit reduction are subject to an unusual degree of political uncertainty. The government has extended most economic support schemes in 2021 to mitigate the prolonged lockdown due to the third wave of the pandemic, which saw GDP contract by 1.7% in the first quarter of 2021. Germany is not the only EU sovereign whose budget deficit will widen in 2021. Germany's 2020 deficit of 4.2% of GDP was well below the Eurozone average and less than half those of France, Italy and Spain, partly because of delayed support payouts, which will now be made this year. A favourable starting position provides fiscal space to use in 2021, which should support a growth rebound. The 2021 stimulus is chiefly via expenditure, increasing the expenditure to GDP ratio, as per Fitch Ratings. Next up are media reports in which US Secretary of State Antony Blinken on Sunday said the United States has not seen yet whether Iran will move to comply with its nuclear commitments in order to have sanctions removed, even as ongoing talks have shown progress. Iran's president last week said the United States was ready to lift trade sanctions, although a senior Iranian official contradicted him, and European diplomats said difficult issues remained. Indirect talks have been underway in Vienna as the Biden administration seeks a path forward with Iran, including how Tehran can resume compliance with its 2105 nuclear deal with world powers. With a fifth round of talks in coming days, Blinken said the discussions have clarified what both sides needed to do. And the United States abandoned the international pact in 2018 under former Republican US President Donald Trump, who reimposed sanctions on Iran's oil, banking and shipping sectors. Democratic President Joe Biden, who succeeded Trump in January, has said he believes Iran is seriously engaging in talks, but that it remained unclear what steps Tehran would actually take to comply with the deal, which was cemented when Biden was vice president under former President Barack Obama. Blinken said that if both sides can return to the original deal, then that can be used as a foundation for both to look at how to make the deal itself potentially longer and stronger, and also engage on other issues, whether it's Iran's support for terrorism, its destabilising support for different proxies throughout the Middle East. But he asserted that the first thing that they need to do is put the nuclear problem back in the box. And meanwhile, the Australian Food and Grocery Council, or AFGC, has released a new report which lays out a vision for doubling the size of Australia's food and grocery manufacturing sector to $250 billion by 2030. The report, Sustaining Australia, Food and Grocery Manufacturing 2030, produced by the Australian Food and Grocery Council with EQ Economics, has identified major opportunities and vulnerabilities for the sector, as well as potential growth paths. Food and grocery manufacturing has a strong presence in Australia as Australia's largest manufacturing sector, employing 276,000 people, with 40% in rural and regional areas. The sector has opportunities to grow through exports and innovation to meet rapidly changing consumer demand, including in the areas of health and wellness and sustainability. However, the sector has faced a number of challenges over the last decade that have hampered its profitability, investment and therefore future growth potential. And moving on to important economic data announcements, New Zealand's retail spending grows 2.5% in the first quarter of 2021, and the total retail sales volumes, seasonally adjusted in New Zealand, rose 2.5% on quarter in March 2021. Higher retail expenditure on electrical and electronic goods and recreational goods helped in improving overall spending in the first quarter of 2021. Some industries showed strong sales while some were negatively impacted amid COVID-19. And New Zealand retail sales volumes, seasonally adjusted, grew 2.5% in the March quarter of 2021 after falling 2.6% in the previous quarter, as per the Retail Trade Quarterly release by Stats NZ. The most significant gain was 8.4% in electrical and electronic items, followed by a 16% gain in recreational items in the March quarter of 2021. Both industries had witnessed a 0.3% and 14% drop in the prior quarter respectively. Elevated retail expenditure on electronic items and outdoor recreational goods during summer contributed to increased total spending in the first quarter of 2021. And retail trade statistics track the sales volume and inventory levels of a variety of firms which sell household and personal items. Supermarkets, car dealerships, gas stations, department shops and cafes and restaurants are some of the examples of retailers. Retail business manager Sue Chapman stated that in the first quarter of 2021, more spending in the electrical industry corresponded with dropping prices for computers and phones. Further, recreational and outdoor sporting products were on top of the charts for many New Zealanders throughout the summer holiday break. And many people were looking forward to being able to travel through the nation for camping, boating or riding sports, as well as a chance to attend huge events like the America's Cup. And now it's time for a short break, but don't go anywhere, as after the break I will be sharing a special report on China's trade restrictions likely to fall flat as Australia eyes the Asia-Pacific markets. The market takes the weekend off, but your money won't. Get a comprehensive update on the ASX listed stocks and market trends. Watch the experts touch upon the fundamental and technical developments and trending strategies in the equity space. We will be your daily guide as you explore the Australian share market, be it global vaccine developments or China's trade relations or global political turmoil or economic revival prospects. We will bring you live updates driving the equity market trends. Kalkine TV. A warm welcome back. Hi, this is Sage and you're watching the Economic Corner show. So let's now look at the special report on China's trade restrictions likely to fall flat as Australia eyes the Asia-Pacific markets. China is one of the leading iron ore importers for Australia. As trade tensions heighten between the two, Australia could potentially be looking at a huge slump in export revenues if things do not go right. As if the pandemic-induced fall in demand was not enough, the imposed tariffs are another roadblock ahead of Australia's economic recovery. Australia has not reciprocated to the move by imposing duties on Chinese imports. Instead, the nation may be looking at options to overcome the adversity of the action taken by China. However, that alone might not solve the long-run problem for Australia. And the tensions between the two leading economies started to arise when Australia supported a call for an international inquiry into how China handled the pandemic when it began, affecting global countries. Australia had also put legislation to ban foreign interference in the country in response to reports of China's intrusion in political matters in 2016. However, China did not heed these allegations, and there were further reports of Chinese interference in the country. In response, Australia and the US decided to take mutual action to confront China about these claims. China's reaction came in the form of suppressed barley imports from Australia, stating customs violations as the reason, and this was a textbook response for China, as the country has a history of suing retaliation measures that handicap the economy of those nations that have called them out for their practices. And the country's government has also received flack for its treatment of minorities and for making territorial claims on unfair grounds. However, China's move is not expected to impact the Australian economy as severely as expected by the policymakers. Australia would be able to find substitutes to replace China's iron ore demand. China fulfills 2/3 of its steel industry's requirements through iron ore imports from Australia. Thus, looking for a new source would entail finding mines with large unfulfilled iron ore supply. Experts estimate that the Australian economy would most likely not see a drastic change. Large-scale mining organisations like Rio Tinto, BHP and Fortescue would be cheaper to service for the Chinese economy because of the geographical advantage offered by Australia. Australia's imports would help China save up on transportation costs, as other potential miners are much farther away from China. Amid these rising tensions, Australia has sensed the need to find alternative markets for its iron ore and LNG exports. And for instance, India is just as big of a market as China. Thus, the demand for Australia's liquid natural gas exports could be met by the Asia-Pacific region, as has been the case with coal. Now for the upcoming events to watch during the week. And the upcoming week is filled with another round of Fed speak and a plethora of economic releases, with many traders focusing on consumer data points. Traders will pay close attention to EU Leaders Summit meeting today, which will include strategy over reaching the EU's 2030 target of reducing greenhouse emissions, Brexit and Russia. On Tuesday, the IFO report and the Conference Board's consumer confidence reading will be released, and Wednesday's RNBZ rate decision and discussions over tapering bond purchases will also be keenly watched. On Thursday, Germany releases the GfK consumer confidence. On Friday, the Eurozone releases economic confidence and consumer confidence data. It is indeed an action-packed week with a lot of economic numbers and events to watch out for. We shall keep you updated on all economic announcements across the globe. Keep watching Kalkine TV and stay updated on all the latest news and market movements. This is Sage signing off for now.